Hello, everyone. I'm Lauren Moon. I'm here with Dawn Garman. We are with Mirador Capital, of course, checking in with you on this Wednesday. It's been a pretty bumpy last few weeks in the markets, as you all probably know. We usually check in with you after our investment committee on Tuesdays to let you know what we're thinking about. Yesterday, Microsoft and Google were reporting earnings, so we wanted to take a listen to those calls and gather our thoughts and relay them to you. So Dawn, what were your takeaways from Microsoft and Google yesterday?
Thank you, Lauren. Yes, hello, everyone. I will start off by saying we recognize this has been a savage period, right? This has been a really, really tough time. And I want to kind of draw on a bit of longer term context for some of my comments, which is, when we kind of remember those dark days of the pandemic and how markets were completely, dislocated at the early part of the year 2020, and then the Fed came in and responded with massive, response in the form of stimulus and we kind of however we got through 2020 and into 2021, and the stimulus that kept in, I think, even through those videos, there was some kind of disbelief. And I feel like I even remember saying, if it seemed bizarre to think that the market's response had been somewhat favorable during those strange days. And I think we can now look back, as the Fed has now obviously put itself in a bit of a box in terms of, inflation being what it is. And so that's all culminating to say, I think obviously, as earnings are being reported and some stocks are getting absolutely obliterated, and we're kind of in this aftermath of all of this stimulus. And now the Fed is obviously trying to normalize policy. What I thought was interesting about the Google report yesterday, which, the headline read that they missed on revenue and missed on earnings. I think that is a headline that, if you look one layer deeper and realize that as a business, Google grew somewhere close to 25% year on year and made, $16 billion in the quarter net of everything, 20 billion gross and 16 billion net, and has a lot of positive characteristics. And I just happened to look at this earlier. The entire S&P 500 is now trading at around 18 times earnings. And so what gives me some degree of comfort in these rocky times is that, as I've said so many times, I do look through our holdings to the companies themselves and ask myself, existential questions about, will these businesses be larger and be earning more money in the future than they are in the present? And then remembering, all those bromides about buying low and selling high, and not knowing that these market dislocations do happen over time, and they have happened many times in the last nearly 3 decades that I've been sitting in this chair. And I think that it's very easy to add to strategies when the chart is up and to the right and looks really cool. It's hard. This is the one asset in the world that people get so much less interested in and fearful of after price goes down. Nearly everything else in our life that we consume, if we believed in the quality and the price went down, we would have a higher propensity to want to have more and not a lower propensity. And so I say this, to myself, which is, this is what buying low, selling high, the buying low part feels like. It's, it is an uncertain, uneasy feeling to do. And so what we're trying to do, and what I'm trying to do, is take myself out of this moment and, and look forward, or look, 6 months down the road back to today, and ask myself, what will I wish I had done? And so, we've had this discussion, you and I,
Mhm.
Why didn't I add more? You know what? Blah blah blah. And so, but we always have those conversations after everything, has had a nice run. And so the point is, I think over longer periods of time, the mechanism of price following earnings will persist. And then if you believe in the companies and what they do and their place in the world, as I do, then it gives me some, at least a little bit more conviction to put some more capital to work. Or the other thing is just to do nothing, right? These times, if we knew with a high degree of confidence that, let's say, the market was going to end up even for this year, well, then that's going to mean it's going to go up quite a lot from where it is now. And so we could fret. I mean, that's part of the weird part about this is prices are so easily seen and, on our phone, and we all kind of live in this kind of constant update and hanging on every twist and turn in the market. And at the end of it, like the people that own massive stakes in these companies and, have built them into the largest companies in the world, not because they're garbage companies, but because they're really good at compounding money and kicking off cash. That's why they're the best businesses in the world. I don't think the people that own those businesses and the largest chunks of them are thinking, that's it, I've got to sell my entire stake, because it's over. Far from it. And so I think we just need to try to keep that perspective, but recognize it's no fun for us either. I mean, it's a bummer to, and this has been a relentless beating, and I think I conveyed this in investment committee yesterday. Somebody said, wow, what a roller coaster ride. And I said, no, roller coasters go up sometimes. And so, it's believe me, it's not easy, but it will work. And it just takes time to play out over certain periods of time. I mean, I don't need to do the laundry list of things going on in the world that is causing this agitation. But I think we look back a year from now and some of these problems will end up having been temporary and we will be moving past them. And once you're moved past them, I've said this, markets do the best when things go from terrible to less bad. So, we've come a long way to correcting some of the excesses that, we've been observing more than participating in. But, we're getting close to the end of this, maximum uncertainty period.
Right.
So anyway, what do you think? What are your thoughts?
I have a lot of thoughts. a couple different categories. I think, to your point, acknowledging kind of the discomfort that goes with this time period. When we look back at charts of where there's pullbacks and when the S&P hits its 200-day moving average, or, it's comforting to see that stuff still goes up and to the right, but it also glosses over how long it can take and how painful it is in the meantime. So I think it's helpful to remember, and it's helpful for me, who have not been doing this as long as you, to be able to kind of learn from your perspective. You've ridden out a few of these cycles. So I think we all benefit from that. I think the other point, just from the recent earnings, Microsoft was more positive than Google, just in that they beat expectations. But I think, to your point, fundamentally, these businesses are growing, and they're growing at pretty remarkable rates. And, what's going on in the market is, the short-term volatility, uncertainty with the Fed, with China, with, COVID again,
Don't forget Ukraine. Don't forget Ukraine.
But we got to take a step back, and Google is still growing. We're not panic selling Google.
Right. And I think we have to point this out as well. In the past, there has been a segment of the portfolio that has been more defensive and going up while the market goes down. This year is unusual in all of our history, because bonds in some cases are down as much as stocks.
Yeah.
So even the way we do it, which is sort of chicken and short, short duration on the curve, we're down way less than kind of the bond indexes, but bonds and stocks have gone down together. So it does give that feeling of nowhere to hide. Cash, automatic loser to inflation, bonds are down, stocks are down. And so then people would go, well, I'll just go put it all in real estate. That's just going to lag. So that's, that's next year's crisis.
This is why we do what we do, is because this requires discipline, right? And so we have parts of our portfolio that are meant to be defensive, and we have a plan for things hitting a certain level and using those defensive assets to, buy more of the attractive assets we do want. So
that's the final point, which is, what will happen, the sequence is, there will be a, seller exhaustion at some price at some point, where the people that, can't take it anymore and, are just tossing over the table and walking out of the building, there will be gone. And then there will be some stability at certain pockets of the market. And then we will take those days to upgrade the portfolio where it needs to be and position it for, the next cycle. And then, to use yet another metaphor, after all forest fires, the sprig comes through the forest floor and the forest starts to grow again. And so, this will be no different. It's just painful to get from here to there, as you pointed out. So any final thoughts?
Use your metaphor. Now is not the time to jump out of the plane.
Indeed, yes. And we feel the pressure, believe me. And I know that seems like the easy thing to do. And maybe over some near-term period of time, it will be the more comfortable thing to do. It just sets up the next thing, which is, what do you do then? You can do that today, and then what do you do then? Because now you've put yourself in a position where only one thing wins for you and no other thing wins for you, which is things have to keep going down by way more than the taxes that you pay, or way more than any of the other variables we could cite. But I think it seems to be that the videos seem to help. And then reaching out seems to help as well, which is send us a text, or Lauren or me or whoever your primary contact is, and have a discussion about liquidity and time horizon and those type of things. I think when we start to strip it down to reality for most of our clients, then we have the ability to sustain many of these type of periods because we've sort of prepared for it before now. So we will leave it on that. And as always, thank you for everything, and reach out if you have more questions, and we will check in soon. Thanks, everyone.
Thanks.